Good morning, Ian.
Hi, James.
Thank you very much for doing this again. It's well over a year, I think, since we last talked to you, but so we're quite keen to see what you've been up to. I think what we're going to do is talk about the fund first and what you're trying to do here and how it works, please. If I can find it.
There you go. It's that one there. Yeah, brilliant. Okay. Morning, everyone. Let me give you literally a 60-second introduction. So, Temple Bar is an investment trust that's been around amazingly for nearly 100 years. I think in a couple of years' time we're going to have our 100th year anniversary. It is, I think, it's reasonably well known for being a UK-focused value investment trust. It was previously run by a chap called Al Mundy, who I'm sure a lot of you would know, and then it was taken over by myself and my co-manager, who's called Nick Purvis, in October 2020. A little bit of background to us for those of you who don't know us. So Nick and I have been running money for about 35 years. So we've got lots of grey hairs and lots of experience. We've been running money together since 2007. As I say, we've been running Temple Bar since 2020. And we are probably best known for our slavish devotion to value investing. So let's jump into the slides here. First question: why do Nick and I believe in value investing? Well, we believe in value investing because we think there's an awful lot of evidence that shows that in the long run it works. And I know immediately a lot of people will sort of be thinking, well, it hasn't worked recently. But this, what you've got in front of you here, is a sort of very long-term study looking at which factors work in the stock market. And what you can see here is ones on the left basically have added value over and above the market return. So value does, momentum does. Interestingly, quality doesn't, and growth certainly doesn't. And I know a lot of people will find that surprising because things like quality and growth have worked recently. But actually, if you think about it logically, they shouldn't deliver an excess return. Do you think you should get paid an excess return to buy stocks that everybody else loves, to buy sort of safe stocks that that everyone loves? That would be a really, really odd world. I can tell you why value investing works, because we get paid to buy stocks that everyone else hates. So let's go on to the next slide, James. I think this is also fascinating. So this is value versus growth by decade. Couple of interesting things to note here. So we've got 11 decades here. Value has beaten growth in 9 out of the 11 decades. What I also think is interesting is that if you look at the 2 decades in which actually growth did better than value, a lot of similarities between them. The roaring 1920s, followed by the Wall Street crash and the Great Depression. And I suppose you could call it the roaring 2010s, when all of a sudden central bankers discovered that put the joys of putting interest rates to zero and printing lots of money and basically setting off a series of asset bubbles. And we know how that typically ends. So, in the long run, again, more evidence that value is a better strategy than growth in the very long run, despite what we might have seen just recently. Go on to the next one, James. And to maybe bring this from the theoretical to the real, these are the returns of Temple Bar since Nick and I took over. And in actual fact, I've updated these this morning, so I can actually give you some sort of more up-to-date numbers than this. Despite the fact that outwardly it would have appeared to have been a tough year, actually we're doing okay again. So year to date, Temple Bar is up nearly 10%. Versus a market of 4.5%. So actually, double the market return. And since inception, Temple Bar, so basically since myself and Nick took it over in October 2020, up 87% versus the market of 45%. So again, nearly double the market return and a very healthy absolute return. Another figure which I'll throw out there, and I think this really will blow people's minds, is that of course we all hear, don't we, about how the UK market is a sort of rubbishy market to be investing in, and you should just be holding the mighty S&P 500. Well, since we took Temple Bar over, you would have, as I said earlier on, you would have made 87% in Temple Bar. What would you have made in the S&P 500? This is if you're a UK investor. So this is in sterling, 45%. So you've got nearly double the return in a rubbishy old UK value investment trust that you would have got in the mighty S&P 500, which I think is quite an interesting fact. Go on to the next one. This is just a long run performance chart. I suppose we're trying to prove here that actually Nick and I have quite a good long run record. So we've run this mandate for a big UK wealth manager since 2000. And Nick and I used to work at Schroders, and we moved from Schroders to RWC in 2010. And the wealth manager actually moved it across. So it is a genuine, unbroken 22-year track record. And again, you can see we've delivered about 405% versus 197 for the market over that period. So value doesn't just work in theory; it appears to work for in practice as well. Next slide. I'm going to canter through these two quite quickly because again we're sort of entering the realms of theory. But what people often ask us, why do you think value investing works? And value investing basically works because, unfortunately, we're all human beings and we all have these nasty behavioral biases, one of which is extrapolation, overreaction and extrapolation. So very simply, when things are good, we tend to think they're going to stay good. And when they're bad, we tend to think they're going to stay bad. And we certainly do that when we're valuing stocks. The chart that you're looking at here comes from a study in which they basically divided up the S&P 500 by growth rates of the companies concerned in the previous 10 years. And then what you're looking at is the valuation at the end of that 10-year period. So the bar over on the right, that's companies which had grown the fastest, and you're looking at the valuation at the end of that period in price to book terms. And very simply, what this is telling you is that people put the highest valuation on stocks which have grown the fastest, and they put the lowest valuation over on the left-hand side on stocks which have grown the slowest, thereby proving that point about extrapolation. Go to the next slide. So that leads to the question, is that a good thing to do? And what this data here shows is that no, it's not a good thing to do, because as much as we all might know and love Amazon and Microsoft and all these companies, incredibly they are the exception, not the rule, because actually there is incredibly little persistence in growth rates. So what this study does, it comes from the same study, and it literally says, okay, we're going to divide the S&P 500 into stocks which grow above and below average. Yeah. So year one, obviously that's 50-50, 50% grow above average, 50% below average. Then we go to year two and we say how many of the first 50% which are above average are also in the above average in that year. Yeah. Just look at the bottom line. If that was completely random, it would go 50, 25, 12, 6, 3. Yeah. Now look at the top line, which is persistence of growth rates in revenue, and it goes 50, 25, 14, 9, 6. So there is very, very little evidence that actually many companies do grow at above average rates, and yet that's exactly what investors do. And in a nutshell, that kind of sums up, I guess, why value investing works. Go on to the next one. And in the stock market, it basically creates this. And so the thin green line is the movement of a share price. The thick line in the middle is a schematic of the value of the business. So what we tend to get is that when a business is doing well, investors will do that extrapolation thing that we just looked at, and they basically put high multiples on high earnings, and they end up paying more than the stock is worth. And then they do the opposite at the bottom. So when things are going bad, and that might be for economic reasons, or it might be company specific or industry reasons, people become very, very depressed, and they basically put very, very low value. They value the business as if things are never going to get better again. And that is the opportunity for a value investor. Basically, when people are valuing things significantly below the actual true intrinsic value of the business, that's the opportunity for you. Now, I would say that this sounds logical, and it is logical, but it's certainly not easy. And as demonstrated by the fact that there just aren't that many of us that do this, because it's really, really hard to control your emotions and to go in the opposite way of the rest of the crowd. You're buying businesses which everyone is telling you are rubbish businesses and are not worth anything and never going to grow again. And psychologically, that's very, very hard to do. But as we've seen in the long run, it does work. Go on to the next one. And I'll just go through this and then maybe we'll pause. There are kind of lots of different reasons why people go through these periods of overreaction. The one over on the left-hand side, I think, is particularly pertinent today, and it's economic cycles. Going into any economic downturn, it is amazing how predictable people's behavior is. What they tend to do is there's a flight out of cyclically orientated businesses and a flight into defensive businesses. And so what people are doing is they're valuing cyclical businesses as if their earnings are going to go down and never recover. And people did that in 2008 during the financial crisis. They did it during the pandemic, and interestingly, they've just done it again for different reasons. But again, that is one opportunity for us as value investors, is basically to buy cyclically orientated companies on the assumption that very few economic cycles just go down and just flatline. They're called cycles for a reason. And then there are other reasons. Capital cycles are a really good one. Commodity type businesses tend to go through these boom bust cycles, don't they? And investors do exactly the same thing. So you go back to 2013 when commodity prices were booming. Investors value those businesses as if those conditions were never going to go away, and of course they do go away, but then they do the opposite at the bottom. They value things as if commodity prices are never going to be improved. So hopefully you get the idea there of I guess how we think about things, and particularly how we think about opportunities.
Good. That's a good introduction.
Indeed. If have you got any questions, James? Or
some questions already. Just do a couple of them. So firstly, valuation wise then, so how does the values of stocks you've got in your portfolio compare to those of the typical index stocks?
Well, actually, could I ask you, James, to go down to that top 10 slide?
Yeah.
There you go.
Yeah, cool.
So I said earlier on that Nick and I have run money for 35 years. We have literally never seen a top 10 that looks like this. These valuations, in our mind, just make no sense whatsoever. Look, you go down that top 10 and you go 5, 6, 6, 6. These are price earnings ratios: 5, 6, 6, 6, 5, 5. It's just extraordinary. Dividend yields of between sort of 5 and 8%. Not even in the middle of the financial crisis actually do I think we saw valuations this low. And the point there is that normally sets you up for a very good period of return. So if you think about when our best period of returns they were coming out of TMT, when nobody wanted to own old economy stocks, coming out of the financial crisis, when again people sort of repeated that stampede out of anything that was sort of cyclical or out of financials, coming out of the pandemic when people did the same, and again we think we're set up now for a pretty strong period. The only thing I'll add to this, James, is that although we're using here 1-year PEs to demonstrate the cheapness of these stocks, when we value a business, we actually try to look 3 to 5 years out, and we try to say to ourselves, where do we think the earnings of that stock can get to on a sort of 3 to 5 year basis? Because going back to my point about overreaction and extrapolation, if you think about it, we're often buying companies whose earnings are at a temporary low point, and we don't want to value them there. We want to value them at a point where we think the earnings have recovered, because we think eventually the market will value them off that. So if let me give you an example there. That third stock down is Marks and Spencer's. They made earnings per share last year, I think, of about 18p. But we think that business has basically got a lot of operational momentum. It's a turnaround story. We think that they'll eventually do earnings of probably 25 to 27p, something like that. So we would use that as the basis on which we value that business.
Okay, that all makes sense. Thank you. Now we're going to jump back, I think, because there's a question here about the valuation gap between the UK and the US, and,
Yeah.
and that's the first chunk of the slides that you put in the deck. So
Yes.
let's go back and do that now, I think, because that's
I think this is.
I thought was interesting.
I think this is really fascinating.
Okay.
Okay, so the gist of this is, I think the US market is stratospherically overvalued, and I'm just dismayed by the fact that so many people are currently selling UK equities to go chasing, selling UK equities to go chasing expensive US equities. The first chart here, it's come from a US fund manager called John Hussman, and what he's done is he's basically back tested all of the different valuation ratios, and this is the one which he has found most correlates with subsequent returns, and it's effectively a sort of market cap to GDP type measure. The point on this chart goes back to the 1940s, but actually you can take it back to 1900. The US market today is more expensive than it was at the peak in 2008, the peak in 1999, and the peak in 1929. Which just blows my mind. And I think, as we all know, it's now something like 70% of MSCI World. So a lot of people have got 70% of their equity exposure because they use these market cap weightings in a market which literally has never been more expensive, bar a few months in 2021. Go to the next one. And we'll sometimes get the pushback. Oh yeah, Ian, but it's only the tech stocks that are expensive. Actually, the rest of the market is okay, and it's not. So what we've done here is we've divided the market up into 10 deciles of valuation using price to sales. So that top line is the most expensive stocks, and the bottom line is the cheapest stocks. All I would ask you to do is look at that bottom line and compare where we are today with where we were in 2008 or where we were in 1999. We're more expensive today, even on the cheapest stocks in the US market, than we were on both of those parts. Go on to the next one. Again, this just blows my mind. So what we've got is using that same sort of market cap to GDP, which was found to have the strongest correlation with subsequent returns. This is literally what he's doing here. So across the bottom, you've got that valuation in history. And then on the y-axis, you've got the subsequent returns that you've got in the following 12 years. And you just can see the most amazing negative correlation there, or to put it into simple English. At times that you paid very high valuations, at times you were paying sort of 2, 3, 4 times. You actually lost money if you compare those dots to the left hand side. You lost, say, 2 or 4% per annum for 12 years, whereas when you bought the market when it was cheap, when it was 0.5, you went on and you made 18% per annum. Now, if you can all see that arrow over on the bottom right hand side, that's where we are today. So today the US market is priced to give you exactly, thank you, James, the price to give you minus 2% per annum for the next 12 years. My guess is that most of you would be reasonably unhappy about that. And of course, it's not, you probably won't get a nice smooth minus 2%. You'll probably get a drawdown in that period. Go on to the next one. Now just contrast that with this. So this being the UK market. So over on the left hand side, this is the valuation of the UK market against MSCI World. And note that this is a 50-year chart. So this goes all the way back to 1975. And, people will often say to us, but the UK market should be cheaper than MSCI World because of their sector composition. And actually, we agree with that. Because we've got more financials and energy and commodity companies, we probably should trade at a discount. But that's why we've put that black dotted line across the middle there. So that's the average over the 50-year period. And the average has been 17%. Today, we're trading at a 45% discount. So we're trading at the sort of widest discount that we've been, bar a couple of months in 2020 for 50 years. And the other thing which really, really interests me is over on the right-hand side, what we've done there is we've compared UK sectors to US sectors. And so, again, this is try to get away from this. Well, the US should be more expensive because it's full of tech stocks. the point that we're making here, look at the third bar across. The third bar across is the energy sector. So that is telling you that UK energy stocks on average trade at about a sort of 35% discount to US energy stocks. You know, if I put that into some figures for you, you know, BP and Shell currently trade on a price earnings ratio of about 5 times. Exxon and Chevron trade on 11 times. Now, those are very, very similar businesses. They're global businesses. The future direction of the UK market makes absolutely no odds to those companies at all, because they generate about 5% of their profits from the UK. The fact that they are listed in the UK, however, means you're buying essentially the same stocks at a 50% discount to their US equivalents. Go on to the next one. This is interesting as well. So this comes from another study, and it basically just showed that when you buy markets whose currencies have depreciated and are cheap on a purchasing power parity basis, they tend to outperform in the future, and vice versa. And there's 2 reasons for that. One is because the currencies tend to mean revert. So having bought a cheap currency, you tend to get that benefit. And the more subtle one is the fact that the companies within that country get the benefit of being of having their currency become competitive against other currencies. So there's 2 reasons. And of course, again, this is very pertinent today, isn't it, where we've seen the pounds until very recently lose a lot of ground against the US dollar, and certainly I would say currencies such as pounds, yen, and euro all look very cheap on a PPP basis against the US dollar. Next one. I think this is. I'll probably finish this section here. The final thing that we would say gives the UK, and certainly a trust like Temple Bar, an advantage is dividend yield. People used to, people particularly in this country actually, used to really be big believers in the power of compounding dividend yield. And anyone who ever bothers to read the annual Dimpson, Marsh and Staunton study will know lots of evidence that if you buy higher dividend yielding stocks, it produces an excess return in the long run, a very significant one. And we can see here that the UK has a massive advantage over other regions. So the UK market today yields around 4%, the US market around 1.5%. Interestingly, even if you strip out the commodity stocks from the UK market, you've still got around a 4% dividend yield. So the US market has a disadvantage immediately on that basis. It would have to produce a lot of excess growth to be able to make up for that. So I think there are a whole plethora of reasons really why investors should be doing the absolute opposite of what they seem to be doing at the moment. Everyone at the moment seems to be selling the UK to buy the US, and I think they should be doing exactly the opposite.
Great, thank you. There's a question just popped up here where I think you can probably answer quite quickly, but basically saying, aren't markets supposed to be efficient? How can this possibly happen?
Yeah. Yeah, you're right. In theory, they are meant to be efficient. In practice, it never ceases to amaze me how inefficient they are. If you look at share prices over time, one of our favorite examples is the share price of Next. In the financial crisis, went from £28 to £8 in 12 months, and it produced earnings per share at the end of that year of £2. So £8 share price, £2 of earnings. So the market basically put Next onto a price earnings ratio of 4. Now, I can kind of see why people were freaking out about banks during the financial crisis. Why you would think it was necessary to take 70% off the Next share price and put it onto 4 times earnings is kind of beyond me. But it's just amazing demonstration of how people's emotions take over. People, as I said, sort of back at the start, if we were all sort of robotic and computer-like, then markets would be efficient. But we're not. We all suffer from these massive behavioral biases, and it's that drives share prices, way above and way below what seem like reasonable levels. And just to finish that story, by the way,
cool.
So in the following few years, next goes from £8 to £80.
Exactly. Good. Right, now let's have a look now back at the fund again. So the few bits and pieces here. First question is about sector exposure, actually. So it's fairly concentrated in terms of sectors.
Yep.
Do you think that sector bias will change over time? Actually, one of the questions that sort of occurring to me when you're talking is like, can you imagine circumstances when you think, actually, this tech stuff's quite cheap, let's have some of that?
Yeah, do you know what? That's a great question, because so people look at the portfolio at the moment, and I think often they think, this is kind of classic value investing, isn't it? It's by buying sort of crappy old energies and banks and so on and so forth. And I think it's so important to disabuse people of that notion. I think it will probably blow people's minds to know that if you went back a few years, we used to own Microsoft, we used to own Relics, we used to own Unilever. Value investing does not mean going and buying rubbishy companies. It just means buying the areas of the market that you think are the most significantly undervalued. Now, interestingly, in around sort of 2010, 2011 time, people, unlike today, had completely and utterly given up on Microsoft. They thought Microsoft was just going to be destroyed by all the other tech companies, and you could buy Microsoft on a price earnings ratio of around about 8 times, and it had a load of net cash on the balance sheet as well. And so, fantastic opportunity. So we used to own Microsoft. So yeah, absolutely, we will rotate around the market to where we see the greatest areas of value. Give you another example. If you went back about 10 years or so, people seem to think that the healthcare companies were just never going to discover a new drug again. And we bought AstraZeneca on what we used to describe as less than its wind up. But so basically, if they never discovered another drug again and you just basically ran the existing drugs portfolio off, we bought it for about sort of 75% of that. So the areas of value do change over time. It just happens that today, because everyone's so fixated on the economic cycle, the value is in the more cyclically orientated parts of the market.
Okay, thanks. A couple of questions about oil exposure.
Yes.
I think it's not directly asked here, but I suppose there's a question in my mind about how do you factor the oil price into that, and is that something that you have to sort of worry about? But also, there's an ESG angle too. Is that something that you worry about? Yes.
Okay. So let me give you a couple of minutes on the thesis for the energy companies. When on that side on overreaction, there was a section marked capital cycle, and we think that these businesses go through these sort of capital cycles, these boom bust periods, and the energy sector is just an amazing example of this. So if you went back to the last peak, obviously capital expenditure went up, and the companies were overspending. Eventually, you get oversupply and commodity prices come down. However, that's not the whole story. The other part of the story, and this is the sort of ESG angle, James, is that these companies have basically been told you've got to stop spending on fossil fuels. They've been told that by politicians, media, shareholders, and they basically have done what they've been told. So, if I told you that capital expenditure of the largest 50, this is upstream capital expenditure of the largest 50 oil companies in the world, is 70% lower today than it was in 2013. I mean, just absolutely extraordinary reduction in capital expenditure. And of course, in this type of industry, you have to continually reinvest to keep production at its current level. You can't just stop spending, and eventually your oil fields start to deplete. And that's what's happened. So supply is basically plateauing, and much as we might want demand for kind of oil and gas to decline tomorrow, it's just not going to decline in the short term. In the long run, yes, but in the short term, no. So you've got this sort of massive imbalance of supply and demand, and I know people will politicians in particular will often trot out the war in Ukraine to explain high commodity prices. That was only part of the reason. Actually, it was kind of small part of the reason. Oil prices were already $90 before that conflict, and they were $90 because of the reasons that I've just mentioned, because we've just taken so much capacity out of the industry. And the sort of final part of the story is the fact that with today's commodity prices, what should be happening is, there's that expression, isn't there? The cure for high prices is high prices. So capital expenditure should be going up. But again, because the companies are under so much pressure, they are not increasing their capital expenditure. So what are they doing with that money? They are quite rightly returning it to shareholders. So that, they're paying you a big dividend, they're growing those dividends, but they're buying back huge amounts of stock, because when your shares are trading on a price earnings ratio of 5, or flip that over, that's an earnings yield of 20%. You can virtually buy back the entire business in just over 5 years. And that's what the companies are doing. They're buying back loads of stock, and we think that's going to drive returns for shareholders in the future.
Centrica's 7% of the fund.
Yeah.
How big do positions get to be? And what gives you the confidence to make that the biggest position?
It's two things, actually. So it's the valuation and the balance sheet. So it's another company with net cash on the balance sheet. It's, you can see there it's valued on 5 times earnings, and we think today's earnings are way lower than potential earnings. So we really, and again, that stock is paying you dividends, buying back stock, etc., etc. So really, sorry, I should answer your first question. Your first question was about sort of limits. We start to take money out of stocks when they get to sort of 8 or 9% of the portfolio. So long as we can find other things to put the money in, so that's where we start to take money out and redeploy it into other ideas. But Centrica is a fascinating turnaround story again. So that was a company which it just diversified horrifically. They bought businesses in the United States and other countries. They expanded geographically. They expanded into other businesses. And as often happens, lots of those things went wrong, and that sort of crushed the profitability. At the same time, in the UK, you had the regulator going for the supply companies, putting price caps on and everything. So it was just everything that could go wrong went wrong. Then you had a change of management, a simplification of strategy, so selling off lots of those that sort of failed diversification. And at the same time as that, you've had a change in the regulatory backdrop. So people might remember when the regulator put these price caps on, one of the unintended consequences was about 70 energy supply companies went bust, because obviously their input prices were going up and they weren't allowed to pass them through to consumers. And so, although that makes great political headlines, unfortunately, you basically just bust the bulk of the industry. So the industry is now back to being dominated by 5 or 6 big players, and more than that, the regulator has realised that actually price caps is a really bad idea. So that part of the business is now significantly improving. And they're also beneficiaries, funnily enough, from the trend that I was talking about earlier on, this underinvestment. So not only have we not they have an upstream business that's benefiting from high commodity prices, but they also have a power generation business. So they own a stake in they own some gas-fired stations, but they also have a stake in basically the British Nuclear, but what used to be called British Energy. And again, despite the fact that we're all meant to be driving electric cars in 5 years' time, nobody's building new power stations, and so what one can imagine, power prices remaining fairly high, and they're beneficiaries from that.
Okay, thank you. So you talked about sort of trimming things when they go to 8-9%. Fair enough. What else drives sell decisions within the fund?
One we describe as competition for capital. So even if something was trading below where we thought it was, where its intrinsic value was, if there was something else where we saw 100% upside to intrinsic value, a new idea or whatever, we would basically take money out of the first company to add it to the second company. That would be one reason. The second one actually is the good one, isn't it? Which is where you think you buy a company for 50p, you think it's worth £1, and eventually it goes up to £1.50 or £2. So you basically take money out of it because you no longer think it's cheap. And then the final one is where we basically have to put our hands up and say we think we've made a mistake here. And you thought the intrinsic value was £1, you paid 70p or something, and in actual fact the business continues to decline. So actually what you've done is you've bought something where the intrinsic value is coming down towards the share price rather than the other way around. The problem with that is, in an ideal world, obviously you spot it and you take money out. The problem is that when that's happening, the market tends to also see it at the same time, and so the share price goes down at the same sort of rate. But theoretically, and we do sometimes, we'll basically say, no, this has been a mistake. This is effectively a structural decline or a value trap, if you want to call it that, and we'll take money out of it.
When you took over the management of the fund, the dividend was cut.
Yeah.
How fast do you think it's going to sort of march back up again? Do you see it growing much beyond the sort of natural rate of growth of income in the market?
Yes, I do. I think we're nearly back to where it was prior to the cuts. You've got to remember what was going on at the time. So at the time that we took it over, we were in lockdown, but we were in the first part of lockdown, and lots of companies, obviously, like the rest of us, I suppose, they just had no idea, did they, how long this was going to go on, what the impact was going to be, et cetera, et cetera. And so companies kind of reacted in a sort of safety first type way. And so lots of companies just thought, right, the first thing we need to do is sort out our balance sheets. One of the easiest ways to sort out your balance sheet is just cut the dividend. And so lots of companies did that. And of course, it subsequently turned out that things recovered faster than maybe people expected, but I don't blame them for reacting like that. So we have had a big recovery in the dividends, and that's been driven by the energy companies. They cut at the start of COVID, but are now they're bouncing back. Financials, actually, do you remember the regulator actually wouldn't let banks pay dividends as we went into the pandemic? Again, that's with the benefit of hindsight, that was unnecessarily harsh. So those dividends have bounced back very rapidly. And I suppose if we look to the future, I would just say, as we're on this page on the top 10, so the average PE across the portfolio is about 8. Yeah. If you want to sort of flip that over, that's an earnings yield of, let's call it sort of 13-14%. The dividend is just over 4% at the moment. So the dividend cover is about 3 times. Yeah, that's sort of 12% divided by 4. And so that should give, we think, room for growth and as we look out in the next few years. I mean more than that, room for pretty healthy growth, actually.
Okay, that's helpful. Thank you. Obviously, everybody sort of hates the UK, and you've seen the undervaluation of that. But even more than that, they hate small caps.
Yes.
Buy more small caps in this fund?
Yes, we would actually. Yes, and actually, it's kind of a project that we've got going on at the moment. We have a new analyst in our team, and we've set him to work on looking at small caps, because I agree with that point. I think there was a long period of time when small cap and mid cap actually we thought it just performed so well. We thought it wasn't good value at all. And that has probably changed in the last year. So it's definitely an area we're looking at. Another thing that we've got him doing is just looking at selectively some overseas stocks, because actually we do think there is some decent value overseas. So let me give you an example. We recently bought a car company called Stellantis. So Stellantis is sort of Peugeot, Citroen, Chrysler, Dodge, all that sort of stuff. As one of the biggest car companies in the world. Believe it or not, that was trading on a price earnings ratio of 3 and a dividend yield of 9, and they pay the dividend once a year. We bought it just before they paid the dividend, so we got a 9% dividend yield sort of straight away.
That's crazy. Yeah. Cool. Okay. Just one quick question on the oil companies. How much are they buying back a year of their balance sheet?
Around about sort of 10%, that sort of order at the moment.
Okay, thanks. What's the attraction of Pearson?
Okay, so Pearson again is this is probably you'd call this I would call this a turnaround, and also you could put this into the structural decliner bucket. So just for those who don't know Pearson well, one of their big businesses is US higher education. So they literally, if you went to college in the US in the old days, you would have bought, a load of textbooks when you're at the start of the year. And they basically produce those textbooks. So if you're doing economics, you were forced to go and buy Samuelson or whatever. And of course, as time has gone on, that's completely changed. So two things happen. One is that there was a very healthy secondhand market via Amazon. And the second thing is that people were consuming more online. And so what you had there was a sort of transition period going on, because what Pearson have done is they've moved from print to digital over time. And that move was painful because basically, you had that transition phase when they were having to put a lot of investment in, margins were coming down, they were taking costs out, you had a string of profits warnings. But we think that you've now basically gone through the I suppose the turning point, and it certainly feels now like the business is now on the up because effectively they have made that transition. And of course it's a pretty high quality business, because what happens now is you go to university in the US and you buy a annual subscription. So it's a much higher quality business. It's because it's repeatable business. It's a kind of Microsoft-like business, if you want to think of it that way. And it was really interesting. I don't know if people remember, a private equity company called Apollo came in for them last year and offered over £9 for the stock. And the management turned it down, and we are glad that they did turn it down, actually, because we think that the business is just starting to get going. And of course you would have handed it across to Apollo right at exactly at the wrong time. So it does feel to us like that business is turning around. And actually it's worth saying actually that's a good example, because when you look down that sort of column of price earnings ratios, that's the one that stands out, isn't it? 15 times. People might say, why on earth are you owning a stock on 15 times? It's because, I suppose, what I was trying to describe, today's earnings we think are at a kind of structural low point and are starting to improve. And actually we think that earnings 5 years out will be significantly higher. So if we value it on the earnings where we think they'll be in 5 years' time.
Back to oil again. Is there any sort of justification in saying you should pay a higher multiple for a US oil company because it's got lower political interference than it would have in the UK?
I accept that point, but I think the answer is no, and I'll tell you why. Because I think what the government is doing is just utterly ridiculous. I know it gets you great headlines when you say, we're going to go and we're going to go and tax BP and Shell and everything. But I think of 12 North Sea operators, 11 of them have basically responded to that by saying, okay, fine, well, we're not going to invest in the North Sea anymore. So, so where is the UK going to get their energy from in the future? Well, we're going to import gas from Qatar and from the United States rather than produce it in the North Sea. I think that makes no sense whatsoever. But going back to your point, even if the UK government are going to continue to do that, and I suspect the Labour government will continue to do that, because the companies only generate about 5% of their profits from the UK, there's only a limited impact actually that the UK government can have on them. So the UK government can't tax them on their global profits, if that makes sense. So actually, from that point of view, there's no real difference between a US company and a UK company, because their profits are generated effectively in the same geographic regions. I
suppose because the performance is coming through and everything's looking a bit rosier, that your discount is sort of narrowed. Would you like to grow the fund? Is that something that you think you can do?
Yeah, we'd love to. We'd love to. You're right. It's narrowed somewhat, but we're still trading. I know this this is unfortunately a sort of investment trust thing at the moment. We're still trading at about 6% discount at the moment, and we have got an ongoing discount control mechanism in place, whereby the broker is buying shares at about a 6% discount, so holding the discount at that level. We find it frustrating, given the fact that the performance has been very good since we took over, and yet we think that the outlook is very, very positive. We're kind of in some ways disappointed actually that we have got that discount, because within the equity income sector, there are funds that I'm sure you'll know, James, that trade on premiums. So I suppose we hope that by getting the message out, by doing things like that, that eventually that discount will narrow and maybe even move to a premium, and potentially we can grow the trust over time.
I think these things are a bit super tanker like. They do gradually get there. You just have to keep delivering.
Yeah.
But well, good luck with it all. Thank you very much for doing this again. I think it's really interesting.
Pleasure.
We'll get you back again in a year or so.
Great. Okay. Thanks, James.
Thank you. We're back next week talking to the manager of Schroeder British Opportunities, or managers, I should say. And then we've got a fairly full lineup of things. We did have Taylor Maritime scheduled for the 25th of August. They've had to postpone, but we definitely will talk to them, and we'll get somebody else in. We've already talked to a couple of people to replace them. But anyway, we will have a full set. Thanks for listening today, and we'll have a good weekend, and we'll talk to you next week. Thank you. Bye-bye.